although we did see Baosheng Bank, for example, was one of the examples of financial institutions that were allowed to fail in China. Do you see regulators paying a lot more attention this time, given what's going on overseas?
If we look at what's happened within the China regulatory landscape since 2017, for example, there actually has been quite a lot of regulatory efforts in pushing forward financial reform to address some of the contagion risks at the smaller Chinese banks. For example, we talked extensively at Fitch about the risks with smaller Chinese banks, back then whether it relates to the off-balance sheet exposure or the fact that at some point for some of these small Chinese banks, it was possible that up to 40 or 50% of their assets were invested in investments. And that, of course, would increase contagion risk if there was stress within the financial system. But with the reduction in some of these off-balance sheet financing, shadow financing activities in recent years, we feel that this risk has subsided for China. Also, more importantly, we do see more examples of preemptive regulatory intervention from mainland authorities, and that also helps restore market confidence.
We have, though, seen some of these signs that potentially they're preparing for the possibility of needing bailouts, a building of the Financial Stability Fund, the encouraging of provincial governments on these bond issuances to recapitalise smaller banks. How much of a turnaround is this, given that there's been a lot more focus on, the avoidance of moral hazard, of market discipline over the last few years?
Yeah. Well, the size of the deposit insurance scheme in China is still relatively small. So in the event of distress, we still expect the state to come in and provide support. And insofar, when we look at the competitive landscape in China at the moment, indeed, the smaller Chinese banks are finding it increasingly difficult, whether it's because of asset quality pressure from properties, for example. The smaller banks tend to have a narrower geographical focus. So for those that operate in lower tier cities, they will be under greater asset quality pressure and also profitability. And that, of course, flows through into capitalization. Much of the recent changes with regards to the proposed new capital rules and also aiming to centralize some of the regulatory power, that really is aimed to reduce inconsistency within the sector, and in that purpose, hoping to improve the comparability and also the supervision for all banks within the system.
You mentioned about more regulatory oversight recently coming from Beijing. Tell us a little bit about how that's impacted some of your views of the smaller lenders that we talked about and perhaps even the bigger ones.
Yeah, by and large, the banking system, commercial banks, basically, it is a confidence model, right? You can't have banks functioning properly if people do not believe in the viability of the banks. And so I think a lot of the regulatory reform really is aimed at reducing systematic contagion risk. It is aimed to improve governance and also transparency within the sector. And these trends, if prove to be sustainable and indeed if the execution of these reform result in better disclosure, then that could be potentially credited positive to how we view the operating environment for Chinese banks.